Question 16 asks us to solve or find the operating cash flow for year 4. We have sales, we have cost of those sales, we can calculate the depreciation expense, and we can also calculate the amount of tax. We have everything we need in order to compute the operating cash flow for year 4. So you want to write down what you have. You're going to start with sales. Then you're going to start with costs. So sales, we got 60,000. Cost, we have 25,000. Okay, that's going to leave us with gross income of 35 grand, right? So far, that's what we got, gross income. Okay, so if we take the depreciation expense for year 4, mind you, the problem tells us that revenues and operating costs are expected to be constant over the next 10 years. So all this information is applicable to year 4. Okay, so we got sales, cost of those sales for year 4. So far, we got 35 grand. Let's take out depreciation. So another expense we have, depreciation. That's going to be, it says from the problem that for the first 1, 2, 3, 4 years, we're given the depreciation, the depreciable amount that we can expense. Okay, so for year 1, 2, 3, 4, we're given 7%. The 7% is going to be the percentage of the equipment's cost that we can take in appreciation for that year. Okay, just think about it that way. 7% times the cost is going to give you the depreciation amount. So we got 7% for year 4. 7% is going to be, I'm going to say, cost of equipment. Okay, 75 grand. Okay, so for year 4, okay, we can calculate depreciation by just taking this equipment cost, multiplying it times our percentage that we can take in depreciation for that year. Okay, so we have our depreciation expense. So if I get a total of what we have so far, okay, this is going to be income less the cost of that income minus depreciation. It's going to be, okay, that's what we got. Basically, this is all of this. 60 minus 25, 60 grand minus 25 grand minus this depreciation expense. Remember, this is just a running total, so don't think about this just yet. Okay, so this is what we have so far. This is our income before tax. We'll just say income before tax. Okay, so we have a tax percentage amount of 35%. 35%. That means all the income that we have for that year, only 65% of that is going to be what we actually can take, because the rest of it is going to be taxed. And I got that 65% because I just did 1 minus 35%, right? So you could also say 35% of whatever income you have before tax, and then back that out of income before tax to get your net income. I just simply took the opposite of 35%, which is 65%, to give me an effective amount of cash that I'm taking home. So if I multiply the income before tax, earnings before tax rather, multiply that times 65%, that's going to give me the amount of cash that I have on hand after tax, right? So let me turn this into 2 decimal places. Cool. So follow me so far. We got sales, cost of those sales, depreciation, and tax. Okay. Another way I could have done this, let's move this over here. Tax. I could just say another cost, tax. So we have our earnings before tax, and the tax amount would simply be equal to this earnings before tax times the tax rate. Okay, that's the amount of tax that I'm going to be assessed at the end of the year from the IRS. I can get this same number. I can get my earnings after tax if I simply back out the taxed amount from the earnings before tax. Same thing. See what I'm saying? All right. So at the end of the year, we have on hand $19,337.50. All right. The problem asks us what's the operating cash flow. It don't ask us about what our net income is. Operating cash flow is basically this amount, the amount that we have on hand after tax, plus our depreciation, because depreciation is a kind of like an intangible expense. It's not a real cash outflow. It's a paper cash outflow, but you still got that money in your account, basically. All right. Long story short. So what we can do to get our cash flow for year 4 is take this amount, earnings after tax, and add back depreciation. That's all that is. And we're given this amount, $24,587.50. And this corresponds directly with answer choice B. So remember, just take your sales, back out all your costs. Once you take out all your costs, and you can calculate your depreciation costs by multiplying the amount of the cost of the equipment by the depreciation amount for that year. All right, that's how you get the depreciation expense. And you can get your tax expense by multiplying the earnings that you have on hand after depreciation by the tax amount. You can get all your expenses. Once you have your income after your expenses, add back that depreciation, and you'll be given the cash flow for that effective year.